We talked about the risk of the 10-year yield going to 3%, and you warned a big correction might be in order. How do we prepare ourselves as equity investors for that potential outcome?
Right, well, the first thing that I observe is that most people are underweight the cyclical stocks, even though they've had a tremendous run, and they've outperformed the oil stocks, the material stocks, the financial stocks. So I would continue, obviously, to overweight the cyclical stocks. And the growth stocks will do well in that environment, but not as well on a relative basis. But if you see, the moment you start to see that 10-year creeping towards 3%, I'd certainly get ready.
How close? I mean, 2.9.
Well,
when do you start rotating?
Absolutely. Well, you can start to, I would have thought, start to take small positions in some of these contra-cyclical stocks. The interest rate sensitive stocks, as I say, the REITs, the utilities, to actually give you some defense against that correction, which should be sharp, because you've got to remember, as we've always talked about, earnings are exploding here.
And we talk about the red flags. Let's go to the other side. January, when it rises, the year tends to be good. Breadth, earnings. I mean, the earnings stats incredible. Tell our viewers and what it means.
Well, certainly, I think 80% of the companies that have reported, I think only 30% of the S&P have reported so far, over 80% have actually beaten on the top line, not just the bottom line. So that's encouraging, because previously it was all about buying back stock and increasing margins and cutting costs. So you're getting genuine global demand here, which is really encouraging. And the breadth in the market is really expanding. I think 88% of the S&P groups are certainly in uptrends. And at the beginning of the year, you saw the biggest increases by the analyst community ever. So then you've got tax cuts, you've got obviously regulation changes, you've now got Trump talking about infrastructure spending. That could add 1.7 trillion. You've got repatriation, what our favourite fruit company talked about the other day. I can't mention the name, but so you've got a huge underpinning of the market, and earnings is generally what drives market. Markets don't basically die of old age and valuation. They die because the economy rolls over into recession. And I think that might give you the excuse to, obviously, as it goes through 3%, that the Fed's behind the curve, and people will start to worry. And at that point, you just start to consider, I think.